Alright, good evening. So as promised to my Discord group, I wanted to put a quick educational video on my credit spreads strategy and how I like to play it. So, this might be a little bit longer of a video, but I'll try to keep it short and just stick to the basics here. But I have the Q's chart pulled up. My favorite ticker to play this strategy, the Q's, SPY or IWM. As for me, I like to play the Monday, Wednesday, Friday contract. So without further ado, I'm going to talk to you a little bit about credit spreads and what that actually is. So here, just pulling up a little bit of some notes on it. Just referencing this website, you're going to find tons of information on this strategy. The thing I like about it is you're basically using the options stuff that you would your options like theta and deltas and all your Greeks that would normally work against you if a stock doesn't work in your favor almost right away, depending on the expiration date. You're using those in your favor because the longer you hold on to it, the higher probability you'll see being successful with this strategy. And it doesn't take a lot of income to start this, but you can using the Qs or the SPY, you can consistently find anywhere from 11 to 18% return on whatever your initial investment would be as far as collateral. So here I'm just going to cut through some of the strategy here and like what this actually is, and then and basically whether you want to play this up, down, left, right. So what a credit spread is basically a two-legged option strategy that you'll either buy or sell an option at or out of the money, and the result is the net credit you receive because of your sell leg has more premium or a higher premium than your buy leg. So there's essentially two. So you have put credit spread, which is a bullish or neutral. So you'll sell an out of the money put and you'll buy an out of the money put, but your sell is going to be closer to the money than your buy leg. And it's vice versa for call credit spread is bearish. So you're selling a call and then you're buying a call, but your sell leg is a little closer to the money. For me personally, you could do one, maybe two strikes apart, but the way it would work, and this is a good example off CP, ticker symbol CP, which is stock Canadian Pacific, but just as an example, using this one as a call credit spread, understand, hey, the trend's going down. I think this is going to be either neutral or it's going to stay below a certain level. So, for this specific example, they're selling a call option and then buying a call option that's a little bit farther out of the money. So, so for this one, they your stock price is at 90.47, so they're selling the 84 strike and then buying the 90 strike, and what that ends up yielding them is a max profit of 225. That's one of the downsides, I guess, is you're minimizing your max profit, but you at least know what you're going to get out of this one. But your risk is going to be the difference between those legs. So here you got $500, well, $5 times 100, so you're risking 500 in order to make this 225. Now this 225, because you sold the leg, you get that automatically, and that'll go into your buying power. So max risk is just the difference between that. This strategy will, just cut down to it. This strategy is going to talk through like, hey, what's best practices, and you'll see like, hey, the best way to do this is, find something that's 45 days out, and then that plays the best when it comes to the Greeks and the 21-day rule. So closing it 21 days prior to, because that's usually when your theta burn occurs with this specific type of strategy. But when you're also going out that far, you can actually get a higher, you can collect a higher return on your risk. So that's basically credit spreads in a nutshell. Is if you think if you think the price is going down, you want to play, or it's going to be choppy and you don't think it's going to hit a certain level, you're going to play call credit spreads. And if this chart was inversed, you'll play put credit spreads, thinking you have more of a bullish or neutral position on that particular ticker. So if we, the one thing I like about Trendsi is it shows us a couple of great things here. One is the regression channel, and then your money momentum. So I know if I'm looking at the hour chart, because I'm trying to play like 1 day out, maybe 3 days, potentially 5 days, where I think the price is going to end up fluctuating to. So when we get a nice trend down like this, and you get some choppy days and like a little bounce, that really matters, because when it comes to options, essentially they move in 5 different directions. They go up, they go up, kind of like this. What we have a nice bull movement we had last week until Friday's drop, where we had that actually like that nice big drop here, or we'll get something like this, or it's just going to trade sideways. Again, those are 5 directions. For a credit spread, if as long as we're right on 4 of the legs or 4 of the potential options for this thing to move, we're going to make money on this credit. So what I'll show you is my strategy using Trendsi is, I like to draw out supply and demand, because I'm big on price action. And as I'm looking at my indicators down here, we got a double bounce here in the green, we're low on the regression channel, and we're hitting a if we zoom out on the hour chart, we're coming close to a level of support for the Qs. So as I'm looking at this, I do potentially see a nice bounce up, but I don't think it's going to come to this level. So as I think price is moving up into levels of resistance or levels of supply, I'm going to look at call credit spreads, and I'm going to basically just let them ride out, because the longer I'm holding these things, the more I'm allowing theta to burn, and the more money I'm going to take in each day. So the one thing I like is, whether you want to play 1 day or the same day, or if you don't have the funds and you want to look at like, hey, it's Monday, I'm gonna play a Friday expiration, you can use this strategy and kind of understand like, hey, I'm down in this regression channel, I'm down in the green. I really do think it's going to either stay above a certain level, or it has a better opportunity to come up. And again, like, that's the beauty of using this indicator on the hour chart, or even the 4-hour chart, depending on how far out you want to look or how far out you want to play. The farther out you go, the farther out of the money you can play, because at the end of the day, like, the risk is what you're willing to invest. So with something like the Qs or the SPY, if you're risking, if you get like 80 contracts, you're risking $8,000, where you might only make 12-15% if you're only looking at something that's like a couple of days out. But the probability of you being right is a lot greater here, and we don't have to worry about theta burn because it's in our favor now. So when I posted my trade today, I'm like, hey, I'm looking, on Monday, I'm like, all right, I think, we had a nice sell-off. There's going to be some bouncing around, but I think at the end of the day, it's going to stay below a certain level. I think it's going to stay below this 312 mark. So, on Friday, I'm posting, or I might not post it, but I'm playing a sell. I'm selling the 311 and I'm buying the 312. So my risk is $100, and that delta, the difference between the premiums might give me a 0.18, which is an $18 return per my 100. So if I'm playing 80 contracts, you're multiplying your risk a little bit, but you're also multiplying your reward in this strategy. And I really do like playing. I like swinging a couple options, and it gives you the opportunity to like close them as we get closer to expiration. because obviously we know the closer we get to expiration, the less, and there's still out of the money contracts, those contracts are going to be worth less. Now the thing working against us on a smaller day to expiration is the gamma. So you can be like, hey, I get this wrong, and I think we're going to have a bullish on Friday, and you were completely wrong. Just a little bit of a spike in volatility and price, your gamma increases. It just increases the leg of your options. So even though you get a put credit spread here at 307, even though price is still farther away from us, the more volatility we get, the higher those premiums end up being, and it's going to show a negative return. So again, it can be a very lucrative passive income for you, but on one awkward, one wrong decision on where this goes, you either got to have a very strict risk management in this and cut your losses so you can trade another day, or you end up losing quite a bit of money. So take it from me, I have absolutely done that, and I've learned from these. But so if let's kind of get into this here. So I'm looking at Qs. This is kind of what I'm looking at. Let me get rid of these. So as stock, so the price of Q, what I think Q is going to do is going to just bounce back up and hug this resistance level, or even this resistance level here it created from the last couple of days. I don't think it's going to break over 308, 309 level. So what I'm looking at doing is scaling in to call credit spreads, because I'm bearish on this ticker and really just the market in general. And I'll, if I think, hey, I want to end up with 60 contracts, I'm going to play 20 off this, and then tomorrow when volatility is higher and maybe this gaps up a little bit and makes a run, I'll load up more and I'll increase my average, because the idea is I want to sell, because this is kind of a sell strategy. I want to sell and make my premiums higher, so that way when we get closer to expiration and this ends up going for back down, that my strategy is right. But I've also trusted my analysis on the market, and I think it's going to either bounce off this level, but I do have a threshold where I'm not willing to risk it above 305. So as I'm watching this, I think it's just using the tickers, the indicators down here. I'm using supply and demand levels, resistance levels, and the regression channel to identify potential either mini trend reversals, and just like I said, playing with the trend on this. So I'm just kind of waiting, and that's really the basic premise of this is patience. You don't have the patience for it. If you don't have the patience to look at your account and see like, oh shit, I'm down $1,000, even though the price of Q is still $8 away. Hey, I'm okay. When you open up something like this early on, you're gonna see some negatives, and then you got to be willing to ride it. But that's just kind of part of it when you're swinging any sort of trade. But again, like, it's in your favor, because we all know, if you're looking to take advantage of gamma and delta, you can do that in the early part of the day or in the latter part of the day when volatility increases. But this, if you can get in early or get in the latter part of the day to swing this stuff, you're in a better position to capitalize on theta decay and basically your overall analysis on price action. So let's take a look on how this will actually look in the options chart. So I just got random ticker here. So for me, this is not this looks like SPY to me, and it's probably a little farther out in the expiration as I'm looking at some of these deltas here. So when you're looking at, let's see here. So when you're looking at a call credit spread, I know that the price of it, is here at the money between 427.50 and 430. So this is your at the money line, right? This 427.50. What I'm looking at is, hey, here's my expiration date, 23 October. I'm going to find, I'm looking to sell here, and I'm looking to buy here. So, because that's 930 and that's 10, that's a $70 or 0.7 difference in the premium. It's a little farther out of the money. I'm risking, $100 to make 70. If I'm holding it to 23 October, again, based on just looking at this kind of stuff, this is probably a few months out. This is obviously a little bit different because you have October 20. So you're not going to see these premiums now. You're going to see something like, if you're going 5 days out, you might see something this far out of the money, closer to like an 11 cent or a 10 cent. For me, that's fine, because I'm going to try to do that Monday, Wednesday, and Friday, and then being right every single time on this. Like, hey, I don't think SPY is ever going to see 442 by tomorrow. That 99% chance, like that's the case. And the nice thing is, if you're whether you got TD Ameritrade, which is the platform, or if you got Webull, or hell, even if you got Robinhood, it'll tell you your sell probability of being in the money. And a lot of bigger firms that run this strategy, they take that into consideration. But there's a 95% probability that my sell leg is going to be out of the money by the options expiration. For me, I'm willing to risk $100 to make $10-11. I mean, it's 10-11% in one day, and this is consistent over a period of time. And then you're talking about rolling profits, accumulating your profits, and then continuing to roll them into more strategies. So you do this a few times, now you can buy more contracts. I've done this with smaller accounts and built those small accounts up, because the compounding profits you get, they start adding up quite a bit when you're making 30-40% on your account each week. For me personally, I risk the same amount each week, or I'm never willing to put more than the same amount of money in the market at any given time. So for me, it's a reliable passive income that I'm more willing to do. Between this and just like buying stock is like the best way to in my opinion, to trade. Just going over here and be like, hey, I'm gonna spend $1,100 or almost $1,200 to buy this out of the money, option call. But if SPY goes against me, this 1190 goes down real quick, and you can see your potential profit fade away rather quickly. So again, that's why I like this strategy. Is I only have to be right 4 out of the 5 times, and using specifically this indicator and some other just technical analysis I've learned between the supply and demand levels, or resistance and support levels. You can be right almost 98% of the time. But the 2% of the time that you're wrong, you gotta learn to hey, cut your losses. Because if you were in a put credit spread here on Thursday, and Friday they came out with whatever news dropped this market, you have to be willing to cut this at a bit of a loss, but understand, hey, I'm willing to take this kind of loss, and it sets me back 2 days, or it sets me back a week. After that, you have to be very meticulous and very disciplined with how you trade this strategy. And if you're not there yet, I'd recommend not doing that, and then just focusing on buying stock and selling it for like 1% gain, and then cutting it for you have a very scripted in and out your entry and exit strategy. And then once you get that developed, and this becomes more or less just a less emotional process for you. So again, this is the way I would look at it. For me personally, I'm starting to scale into call credit spreads, as I've locked in some of my profit on the put credit spreads that I was playing earlier today, as I basically day traded those, as I thought, hey, we should see a bit of a bounce here, but I think that bounce isn't going to be significant enough to push us over that 308, 310 level, which is what I have expiring tomorrow. So if you have any questions, if you're on Discord, DM me or hit me up in my channel. If you're not in the Discord, I highly recommend joining up, and then grabbing yourself this very useful, probably, like I said, I've been trading for about 5 years, and this is one of the most useful indicators I think I've ever used, and it's one of the preferred on my, between stochastic RSIs and CCI. This is one of my favorite setups as far as looking for potential swing plays, which most traders don't have the 25 and up for a PDT, or they don't have the, if you have a cash account, you can't really play this strategy because of the tier option level. But if you have a margin account, and you can't day trade, or you're trying to get away from day trade and you're just trying to make a passive income, hey, this is a great way to do it. Like I said, I'll have a link in my bio, and if you're interested, message me or comment below, and I'll get back to you. But for those in the Discord, I'll be trading this live on Friday. We'll do some scalps, and we'll look at some setups for some credit spreads. All right, thanks.